Hello and welcome. You're watching the Global Reset from the CNBC TV 18 Prime Ionic Wealth Studio. I am Prashant Nair. Today on the program, we will be joined shortly by Praveen Jagwani, CEO, UTI International, to talk about India's rising weight in global portfolios. The big question, of course, here in India is when will FIIs make a comeback? And of course, we'll also talk about what his view is about global equities as we head into 2026. Let us begin, as we always do, by taking a quick look, though, at what's happened on the market and global news front so far. We're, of course, coming out of a weekend. The U.S. market ended Friday's trading session kind of mixed. The actual closes on both the S&P and NASDAQ don't show very much by way of change. But the fact is, NASDAQ futures sold off about 2% into the cash open on Friday, only to recover. The S&P had recovered about 1.5% from the lows. Even the bond market saw a fairly volatile trading session. Technology stocks continue to sort of, wobble a little bit. On the other hand, the worries around the health of the U.S. consumer perhaps also rising a little bit. Bond market rates also on your screen. Now, the Fed hawks are continuing to express skepticism about a rate cut in the month of December. More and more people are kind of, joining that bandwagon. At the beginning of this month, that is the month of November, the odds of a rate cut in the month of December by the Fed were pretty high. Now, it's pretty much like a coin toss, 50-50. Markets in Asia are mirroring cues from Wall Street. Trading remains mixed. Back home here in India, Nifty is trading within a range. It's up, but up very, very small. Well, staying with the U.S., in a major policy reversal, U.S. President Donald Trump has rolled back tariffs on more than 200 food items. The move comes amid rising frustration from Americans over soaring grocery bills and marks the administration's most significant attempt yet to tackle stubborn food inflation. The White House says lower import duties could ease pressure on household budgets, but economists are split on whether this will be enough to cool prices in the near term. Take a look at this report.
U.S. President Donald Trump has rolled back tariffs on more than 200 food products in the face of growing angst among American consumers about the high cost of groceries. The new exemptions were announced on Friday and include such staples as coffee, beef, bananas, and orange juice. They took effect retroactively at midnight on Thursday. The move marks a sharp reversal for Trump, who has long insisted that the sweeping import duties he imposed earlier this year are not fueling inflation. Trump was asked about the rollback aboard Air Force One on Friday evening.
Mr. President, you said that your tariffs do not increase prices for consumers, but now you're lowering tariffs.
They say they don't. I say they may in some cases, but to a large extent they've been borne by the country. As an example, we have virtually no inflation.
Trump also said he would move forward with a $2,000 payment to lower and middle-income Americans that would be funded by tariff revenues.
Now we're going to do a dividend, and we're also going to be reducing debt.
Friday's list of exemptions includes products U.S. consumers routinely purchase to feed their families at home, many of which have seen double-digit year-over-year price increases. The White House said Trump decided certain food items could be exempted since they were not grown or processed in the United States, and after, quote, significant progress the president has made in securing more reciprocal terms for our bilateral trade relationships. Trump has focused squarely on the issue of affordability in recent weeks.
Our work to lower the cost of living,
while insisting that any higher costs were triggered by policies enacted by his predecessor Joe Biden and not his own tariff policies. Democrats have won a string of recent victories in state and local elections in Virginia, New Jersey, and New York City, where growing voter concerns about affordability, including high food prices, were a key topic.
Well, and on to the broader economic picture from the U.S. As markets look for clues on the direction of the U.S. economy, the Trump administration is more upbeat for the outlook in 2026. In an interview with Fox News, U.S. Treasury Secretary Scott Bessent says that he expects to see a substantial acceleration in the U.S. economy in the first and second quarter. He added that 2026 could be a great year for working-class Americans and for markets as well, signaling a period of stronger job creation. Listen in.
I think we are going to see a substantial acceleration in the economy in the first, second quarter And I think we are also, we're already seeing on many prices, as I said, we're bending that curve down, and the increase in real incomes, I think Americans are going to feel it in the first quarter, second quarter. I think 2026, thanks to President Trump's signature plans, is going to be a great year for working Americans, for the markets. I call it parallel prosperity. Main Street and Wall Street can both do great, but I think Main Street's going to have a great year in 2026.
Staying with those comments from U.S. Treasury Secretary, Bessent also weighed in on the ongoing negotiations with China over critical rare earth agreement with supply security and strategic minerals. Back in focus, Bessent said he's hopeful that the deal with China can be wrapped up by Thanksgiving, that is late November. Listen in.
I think that Wall Street Journal reporting is not very accurate. We haven't even finished the agreement, which we hope to have done by Thanksgiving. And I am confident that post our meeting in Korea between the two leaders, President Trump, President Xi, that China will honor their agreements. Xi Jinping has great respect for President Trump. The meeting was conducted very high level, and I am confident that they will honor their agreement. And if they don't, we have lots of levers.
Yeah. Well, we'll take a quick break. Up next, as promised, Praveen Jagwani, CEO, UTI International, joining us. Stay tuned. Welcome back. You're with us here on CNBC TV 18 Prime. You're watching the Global Reset. Well, as promised, Praveen Jagwani, CEO, UTI International, is now joining in. Praveen, welcome to the program. Thank you very much for joining us. I want to just preface my question, and the question is about India-US. And, with this Bihar election behind us now, all eyes on whether and how fast at least these penal 25% tariffs can be gotten rid of. So there was this sort of social media post by the oil minister, Mr. Hardeep Singh Puri, this morning. And I don't know if you've seen it, but let me just quickly read this out for you and for our viewers who've missed it. And this is what it says, and I quote, "A historic first. One of the largest and the world's fastest growing LPG market opens up to the United States. In our endeavor to provide secure, affordable supplies of LPG to the people of India, we have been diversifying our LPG sourcing. In a significant development, Indian PSU oil companies have successfully concluded a one-year deal for imports of around 2.2 million tons per annum LPG, close to 10% of our annual imports, for the contract year 2026 to be sourced from the US Gulf Coast. The first structured contract of US LPG for the Indian market. This purchase is based on using the Mount Belvieu as the benchmark for LPG purchases, and a team of our officials from Indian Oil, BPCL, HPCL, the three oil marketing companies, had visited the US and engaged in discussions with major US producers over the last few months, which have been concluded now." I mean, Praveen, let me just begin by asking you, would you see this as a prelude to sort of, it's give and take? So is this some give from India's side before we get rid of this penal 25% tariff to begin with? What's your sense?
No, absolutely, Prashant. In any negotiation, there has to be the effort to arrive at a win-win solution. It cannot be one-sided. And this is the first of many concessions that India has made. And I would imagine there would be more, particularly in the agricultural segment, where India would be also buying some of the US agricultural produce. And similarly, in the same vein, even US would be buying more stuff from India, as we'll figure out when the deal is finally announced to public. So I'm very pleased to see this, because in the current global regime, appeasement of US to some extent is the only way forward for everyone to get on with business.
Would you say things should move fast now? At least in this one day, one fine morning, we'll wake up with perhaps a truth social post saying, "Well, I'm."
Which will obviously proceed. Yeah, those things tend to precede the actual events themselves. And I won't be surprised if before end of the year, we see a US-India trade deal inked with the aggregate tariffs below 20%.
So you're saying, so not just the 25%, but I mean, the remaining 25 also gets worked down to, you're saying, to 20%. something around that level.
Yes. I mean, the fact that food is such an essential part of any economy, and the US government has quickly realized, as you've seen, the food prices are now rising at an alarming level in the US. Um, and therefore, the US government has to do something to manage that political challenge, if you will. I mean, food is really interesting. If you just think of hamburgers, for example, America has a population of 340 million people. You remove the children, the super old, and the vegetarians, that leaves about 280. On an everyday basis, everyday basis, 140 million hamburgers are sold in America, which means 1 out of every 2 eligible Americans eat a hamburger. Now, the price of a hamburger, a Big Mac, in 2020 January was around 2.75, $2.75. Today, the median price is $5.69. Price of a hamburger, which feeds all of America, has doubled in the last 5 years. That's obviously politically explosive because wages haven't kept pace with that. And hamburgers feed really the bottom half of America. And we have a consumption problem in the US, and food is central to that.
Yeah. You know, absolutely, and I think that's well put, using the example of a hamburger to describe what's going on, at least with food inflation. Praveen, I'm going to come to you. You know, there's a bit of an echo in the audio, and we want to just fix that. So allow me, while we fix it, for our audiences, play out, a conversation that my colleague Lata had with Leif Eskison, chief economist at CLSA, about their view. There's a conference underway here in India, the CITIC CLSA conference, so this was on the sidelines of that. This is Leif's view on India and, what do they make of nominal GDP growth picking up here, because that's a big one. Listen in.
Yeah, so if you look at the current fiscal year we're looking at growth coming in just a hair below 7%, so 6.9% to be exact, right? So relative to the first quarter of the fiscal year, it does, you can say, imply some slowdown in growth during the remaining 3 quarters of the fiscal year. That sort of slowdown, I would say, is sort of driven essentially by 2 factors. One is because the government has to sort of rein in to some extent, you can say, spending to meet the deficit target. We think there'll be some sort of slowdown on that side, maybe sort of government-led infrastructure type investments. And then also the sort of, should we say, lagged effect of the higher tariffs that got imposed on India from the US, and also a slowdown we're seeing in global trade in should we say, in coming quarters as well, would be the 2 factors that will drive that. I guess if we start to see the effect of some of the GST reform, that could provide a bit of a lift to the consumption side of things, right? So that's why the slowdown we are looking at in the remaining of the fiscal year is not that significant. So as I said, full year fiscal at 6.9%.
Would you put an upward bias to that 6.9 because of the GST cuts and the probability of a trade deal with the US?
Yeah, certainly, I think the chances of a trade deal have gone up, right? I mean, Trump has certainly indicated as much, and the 2 sides are still negotiating on that front, right? So whether it happens in this calendar year or in the beginning of the next calendar year, so the last quarter of the fiscal, we'll have to see, right? But I suspect that we could move towards a deal, right, where maybe the tariff rate that's imposed on India lands at something similar to what we're seeing for other Asian economies, to say around 20% thereabouts, right? And then, of course, there'll be some give and take also in terms of purchases and opening up for certain sectors, that will be part of that broader deal, sort of in similar fashion, but not quite the same as we've seen from some of the other Asian economies, right, where they've entered deals with the US.
Do you see the global view on India changing? We've seen the largest amount of foreign investment outflows from India.
Yeah.
But now, as the GST cuts and the income tax cuts in India work in and earnings improve, and probably the trade deal comes in, do you see the movement of funds back into India? I mean, a lot of the rupee depends on that. That's why I'm asking.
Yeah, I mean, so I think given our view on, should we say, U.S. equities being quite frothy, right? And should we say a little bubbly, if you will, right? I mean, we do also see a relatively high probability of a correction in U.S. equities, and that also would imply, should we say, more of a sort of less risk appetite, more broadly speaking, globally, right? So I think it will be hard for Indian equities to sort of buck the trend in that type of environment. But if you look, should we say, beyond that potential correction, and if there's also maybe some further correction in India in the context of that as well, right? And valuations are maybe somewhat less, should we say, challenging to the extent they are now, then maybe there could be a bit more scope if we start to see the GST reform adding to the growth impulse in India, right? And if growth holds up relatively well, that there could maybe be some resumption on the other side of this of equity investors coming in, right? But I think valuations still are quite high. I think positioning domestically is still quite long in the tooth as well, right? So I think that is still something that does pose, I guess, challenges from the point of view of foreign investors in the near term, right? So maybe a healthy correction could be a good sort of starting point, right, for seeing flows coming back in.
Praveen Jagwani is back with us, CEO, UTI International, hopefully on a better line. Praveen, thanks for waiting while we fix that audio issue. So I got that. I mean, the US point is, I get that sense from you. Now, let's talk about the other big sort of issue which is being discussed here in India, which is the fact that everyone agrees that earnings downgrades are slowing down a little bit. Valuations are still high, but maybe growth picks up because of rate cuts, tax cuts, etc. But the risk seems to be, as some have pointed out, not all and not everyone agrees, that if the US, because of there's this big boom in AI stocks, were to correct in any meaningful fashion, no one is going to be spared. Does the risk lie out of the US, even for a market like India, which, if anything, has sat out of this entire AI-led rally?
No, absolutely. When we are going through this phase of lull in Indian equity markets, we worried about it, that foreign investors are not really participating. And it's just been left to domestic Indian investors to carry the weight for Indian equity markets. But it might just be a blessing in disguise, because when the AI-led tech rally in the US does eventually correct, it'll have repercussions around the world, including emerging markets, the likes of China, Korea, Taiwan, which essentially have been extensions of the technology or AI play. So when the Magnificent Seven, or now it's with Broadcom and Palantir, the Mag 10, when eventually they correct, yes, there will be a ripple effect on India, but I would imagine a lot more muted, because foreign investors haven't really committed themselves to Indian equity story for the last 2 years. On the contrary, when the dust settles, I would not be surprised if foreign investors come back in a meaningful way to Indian equities, simply because India might be the last man standing, where there is predictable, consistent earnings growth, thanks to the domestic economy, which is doing really well.
Not as well as we would like it to, right? I mean, under 10% nominal GDP growth, Praveen. I mean...
Yes, I mean, compared to historical standards, yes. We are not punching even at our weight. But, I mean, everything being cyclical, I would imagine where inflation is, real rates are, there is a scope for RBI to cut rates. And there is potential for global investments to flow through to India as soon as the magnificence of the AI trade starts to diminish somewhat. See, if you look at the US, its weight, US is 49% of global market cap, but its weight in the MSCI ACWI, All Country World Index, is 65%. So it's punching way above its weight. India's global market cap weight is about 4%, but in the ACWI, it's only 2%. So India is punching below its weight. But if you look at the actual allocation to India, is not even 2%, is 66 basis points as a percentage of global assets. So India has really been left out of this run-up we have seen in the last 2 years in global equities led by tech. So when that does collapse, I would imagine India won't be hurt as much. If anything, India has a quick turnaround and enough to gain from that foreign flow.
Yeah. You know, UTI International offers various strategies, products, etc., for overseas, for foreign nationals, individuals, etc., products to access the Indian market, Praveen, right? And I imagine you meet all kinds of, funds and institutions, etc., and as they allocate. Just a broad, I mean, if there is a way to do it, ranking areas of interest as we look into 2026. While you're focused on India, I'm sure you talk about where else within emerging markets is the maximum interest. So we're just curious, what's the, not pecking order, but how do things stack up now?
Things get very thematic. So the most popular trade, of course, is the Mag 7, which has, in the last couple of quarters, been replaced by gold or precious metals in general, which has now extended into platinum, palladium, and rare earths. So real assets, as a recognition of the broader trend of de-dollarization, that's what's keeping global investors, pension funds, and sovereign wealth funds sort of awake. Unfortunately, much as you and I might like to believe that India is relevant, it's not really bubbled up into a conscious decision point just yet. Because, like I mentioned earlier, 65% of global allocation is US, and then you add in the rest of the developed markets and throw in a bit of China, there isn't a lot of space left to really consider India. So the fact that India hasn't received a whole lot of foreign investment in the last 2 years has nothing whatsoever to do with India. It's just a risk aversion in general, because the Mag 7 or Mag 10 have done so well that carrying on with the momentum trade has made more money than trying to be contrarian and going into far-flung places like India, simply because the domestic consumption story of the Indian middle class seems to be compounding. So our time will come, I suppose, but it's just that other things have been more interesting, mesmerizing for the past 2 years.
Yeah, no, absolutely, and I think that's a good way to put it, Praveen. We'll leave it at that for now, but I hope we can do this once in a while to get a sense of what's happening, right, with regards to feedback from asset allocators to emerging markets and, of course, global allocators, etc. as well. Really appreciate your time. Thank you very much for joining us, and good speaking with you here on CNBC TV 18 Prime. Well, that's Praveen Jagwani, CEO, UTI International. I think we're going to wrap up this edition of the Global Reset. Thank you very much. I hope you found that conversation useful. More comes up after a quick break.